Why leverage is a disease in crypto? Many novice traders suffer losses when trying to trade using leverage. In fact, many of them were liquidated and lost all their assets. Then, why can leverage be considered a disease in crypto? 1. Leverage damages retail psychology. The main thing that can be considered a disease given by leverage here is that leverage gives retailers too excessive expectations. Retailers who are still beginners see leverage of 100x or even 125x as a means to double their money in an instant. Those who are tempted by the multiplication numbers forget about money management and go all in until they lose all the assets they own. Leverage and addiction to seeing P&L keep going up and down damages retail brains, and eventually they become addicted to continuing to trade using leverage. 2. Leverage destroys prices in the market. Leverage can cause an artificial increase in crypto prices. For example, the cumulative buying power of the market should only be able to increase the price of Bitcoin from $90,000 to $93,000, but artificially they have the buying power to push the price from $0 to $100,000. Of course, this is not as good as imagined, because when long-term Bitcoin holders sell their Bitcoin spot positions in very large amounts, it will cause a significant price drop and cause a very long downward wick candle. This causes liquidation and retailers lose their position and overall assets because the increase was artificial from the start. 3. Exchanges get greedy and trade against their own customers. When a retail position is forced to be liquidated, the exchange will indirectly gain a profit. Usually, the liquidation fee is up to 15% of the liquidated position. The 3 parties who gain profits when a trader is liquidated are the exchange, insurance fund, and also the market maker. This is why many exchanges end up trading against their own customers and do stop hunting, because many traders use leverage and exchanges definitely know where the traders' liquidation positions are. 4. Leverage provides systemic risk to the crypto ecosystem. Leverage, which gives retail a lot of buying power, ultimately also poses huge systemic risks to the crypto ecosystem. Many crypto companies that use leverage in their operations ended up going bankrupt, such as Alameda and FTX. Many DeFi protocols such as Celsius and Luna also went bankrupt due to excessive leverage. That's our explanation about this video. Help me develop by liking and subscribing to this video so that I can continue to provide education and also my analysis of the Forex and crypto markets. Thank you, and see you again in the next interesting video.